Hello, everyone, welcome. Good morning. It is 6 a.m. on Monday, June 10th. We've been waiting for a catalyst for a while in the markets. The S&P 500 has been chopping sideways and it's been really low volume. And one of the things that you've heard me repeatedly say is that we're waiting for volume. We're waiting for a catalyst. Well, this week we have a lot of potential for catalysts. And let's take a look at what's on the economic calendar. Today, nothing much. We got some T-bill auctions, and we got late bonds later on this week. So we got a bunch of T-bill auctions throughout the week. So nothing too much today. PMI and ISO. Is this right? June 3rd. This is not. This is not right. Here we go. Yeah. T-bill 3-year note auction. So this will be somewhat more significant than normal. We have the 3-year note auction in there along with the T-bill auctions. How much participation we get in the shorter end of the market and even the longer end tomorrow, that's going to be indicative of what people might think that the Fed is going to do with rates later on this week. But there can also be very low participation because people are waiting to see what the Fed is going to do. Uh, but we're not going to put too much faith in it or too much emphasis in it because we do have a lot more important stimulus coming up later on. So today, not too much going on. Tomorrow, we have the beginning of the FOMC meeting. But then Wednesday, we have the CPI comes out just before, a few hours before the FOMC announcement comes out. And then Fed Chairman Powell starts to speak. So Wednesday is really going to be where a lot of the action is. Since there's nothing going on Monday and Tuesday, this market most likely is going to be waiting for Wednesday. Not only do we get that CPI report, which obviously can't be figured in entirely into the FOMC announcement just a few hours later, but we've got the actual announcement coming up. So CPI will reflect more into July than it will into the current announcement. And then the very next day, we've got the PPI, and we end the week with consumer sentiment. So there is a lot going on, particularly in the later half of the week. And if the FOMC announcement and CPI don't do on Wednesday, then we've got PPI and then consumer sentiment on Friday. This week, we should have some sort of catalyst to get us going. But it also looks like that today and tomorrow might be super quiet because if I was an institutional fund manager still, I would be waiting. I wouldn't be doing much. Just like in our current portfolios, we're waiting. There's a well, we reflect what the professionals are doing, right? So we're not going to the professionals aren't going to be trading much today and tomorrow. Neither are we, because then who are we trading against? We're trading against retail guys, and retail guys don't move markets. They'll have a very temporary effect. Uh, so if we see prices moving today and tomorrow, especially on very low volume, then we cannot trust that that action or that movement will continue into the next day and the next. So if I have $10,000 to invest, or even if I have $100,000 to invest, and I want to buy a stock or an option on a stock, doesn't matter what it is. Let's just say the hot stock right now is NVIDIA, and they do a 10 for 1 split. So it's at 120 today. So now suddenly it becomes a little bit more affordable. But how much more affordable? If I have $100,000, I still can't afford even 1,000 shares of NVIDIA. That's not going to move the markets. I can buy 1,000 shares. What's the volume on this? 7.42 million in a day. My 1,000 shares is going to be absorbed in seconds or minutes, which means that my entire buying power is gone in just a few minutes, which means I can't buy more NVIDIA tomorrow. And if I can't buy more NVIDIA tomorrow, I can't keep pushing the price up tomorrow. Institutions have hundreds of millions of dollars, billions of dollars sometimes, and tens of millions of dollars, sometimes depending on how big the fund is, even hundreds of millions of dollars might go allocated to a very small basket of stocks. And it can take them months sometimes to finish their buying or selling programs, which means that today they buy, tomorrow they buy, the day after they buy, they keep on buying. And that's why we get these trends, because they keep on buying, or once it pulls back to a certain level, then they resume buying. So they might buy, and go, oh, we're moving the price too much, and wait until a pullback before they start buying again, wait for a pullback, buy. So that's why trends actually develop in the markets. If I'm trading against retail guys only, it's to day trade. And because the retail traders are not going to be able to carry that trend forward. So if I have a clue or a very strong idea that institutions are not going to be in the markets, then I'm going to sit on my hands if I'm a swing trader. I might not if I'm a day trader, but then I'm looking for very short action, and none of my trades will carry into the next day, what brokers love, because then they eat up all these commissions going in and out, in and out. So one way or the other, you're playing with institutions. You're playing with your broker and your market makers, or you're playing with institutional traders and investors. And the way that you're going to make money is by following institutional investors. So if we're not anticipating that the institutions are going to be in the markets today and tomorrow, at least not in any sort of force or size, then we're going to sit on our hands because we're not day traders. Or at least I don't show and I don't teach day trading, because you have to really know what you're doing. Uh, the average person, when they first learn day trading, they're just going to get their lunch taken away from them for a really long time until they get a feel for it, because of what I just described. Because normally you're trading against really big institutional money that knows what it's doing. And if you don't know what the institutions are doing, then they're just going to take your money away from them. If you know what they're doing, then you follow their trades, and then you make the money that they make. So, and then otherwise, the other thing that makes day trading very difficult is those brokerage fees. So if you take a position overnight, then you're paying interest rates. If you're going in and out many times during the day, your profits are getting eaten up by commissions. So day trading really is a game for people who have size, because that's the only way you can offset those day trading commissions, is if you're going in and out multiple times a day. Okay. Enough of that sidetrack. And we're not really going to expect the market or the institutions to be in the market for the first 2 days. And so really our strategy will be, let's wait till Wednesday, how volatility comes in and hopefully volume comes in, and then we can start making our moves. So what sort of things might we expect? Well, let's take a look at the DXY. DXY is trading in this channel, and Friday it moved aggressively upwards, and you can see that already today. Remember, currencies trade at 24/7. They only have a 1 hour pause every day, and they trade even on the weekends. So this is already reflecting things that happened over the weekend and earlier this morning, and we're up. So this bounce looks like it's going to continue, and most likely keep on moving to the top of this channel. That's going to put pressure on gold. That's going to put pressure on oil, on all sorts of commodities. It'll even put pressure on stocks. It'll put pressure on bonds as well, but it could be a reflection of. So if I'm going to buy US Treasury bonds, I need to buy them in US dollars, just like every other commodity, or for the most part, usually gets transacted in US dollars. And so there's demand for this dollar in order to buy a US asset, or is it demand in the US dollar simply because it's seen as safer than other assets, or are people desperately trying to sell out of other currencies simply because there's something going on with those currencies? Not just from this chart, we don't know. Uh, so what are people buying US dollars for? Uh, is it for treasuries? Is it for gold or for something? It's probably not one of those. Okay, it's probably for something else. More likely a safety reason. So there was news on Friday that China was going to stop using gold as a safety reserve. So there might be less buying in the gold market because China, it doesn't mean that they're necessarily going to dump their gold. It just means that they're most likely not going to buy as much gold as they used to. So that's why prices dipped, and then the US dollar is heading upwards. Yeah. So that'll have an effect. It'll put downward pressure on stocks as well. TLT, we see that we gapped down hard on Friday, and it looks like this morning we're continuing to move downwards. Looks like we're going to open at or slightly below this upper trend line. So those longer term, uh, longer term for us, uh, trades. So those August expiration trades that we showed, there's two of them. That one was taken the first time we hit this channel, the top of this channel. The second was taken basically at peak. And then it looks like today we're going to get our third entry. So where are our safe trades? So in our TLT trades, our two TLT trades, you can see that they're doing very well. And we'll probably enter our phase 3 entry today. So basically, I would expect to, at the open, to enter phase 3. I can't put it in right now because I don't know if the prices are reflective of this move already. And if I put it in now, maybe I'm giving myself an unfair additional P&L performance right there, right? So I'll put it in immediately after the market opens, and then we'll have our third trade. Then we'll have a fully allocated position in a TLT short that we'll expect to hold probably pretty close to July 31st when that great decision comes out. Or actually, probably not until July 31st. Once it becomes clear that the market is waking up to the reality that we're not going to get a rate cut in July, and these collapse to zero or very close to zero, maybe 2% or 1%, then that's roughly the time that we'll be exiting those three positions in TLT as well. So VIX slightly elevated. So we did not expect that this would come down even further. So we are getting that little bounce. As long as we stay under 15, then I wouldn't really consider it much of a signal. If we break above 15, then we are probably moving significantly lower in the SPY. As we stay under 15 and we're just bouncing in this box, which at some point would probably include that MA50. So if that does spike, the VIX does spike above 15, then we're probably looking at a breakdown below the box, which at that point might include the MA50, might include the MA90, which means there wouldn't be a lot of resistance, and we might go all the way down to that MA200 and get that 10 to 15% pullback, the 10 to 15% pullback that we generally get per year. So we'll be watching that very carefully, watching that VIX. But other than that, there's not going to be a lot to talk about. We'll take a quick look at gold. Gold, you can see On Friday, it hit this very, very important point right here. So this flat area right here, horizontal support. And if we break this significantly, then it looks like we could be in for a sell-off in gold. So far this morning, looks like it has bounced off of that level. So that level is still holding for now. As long as that level is still holding, then we might see another wave up to one of these highs. Or if we only get up to here, then that is a series of lower lows, and then we'll just expect that it's just temporary. Gold is chopping sideways temporarily and perhaps might break down in the future. So if you're in the gold market, I would just be very careful right now. Consider hedging yourself or taking whatever profits that you have because it's becoming more risky. That's the only reason why. Not to say that it will break down. It's just becoming riskier to hold if we keep repeatedly bumping against that level. And we have lower highs. So that's going to be it because there's just nothing to drive this market today and tomorrow, at least nothing that we can see other than NVIDIA. Other than that NVIDIA stock split, that might drive some volatility today, but it'll be very localized in NVIDIA, first of all, and then in the semiconductor space. Second, we might get some bleed off into the semiconductor space. So in the post market, we'll look and see what sectors outperformed or underperformed. Most likely, we're going to see outperformance in the semiconductor space. And if that's the only one, then we're on very weak legs. We wouldn't trust any move upwards. And outside of NVIDIA, we're not really going to anticipate that we're going to see a lot of market participation, whether it's retail sellers or institutions. The NVIDIA might absorb everyone's buying power today. So, and institutions aren't going to make, they might participate in NVIDIA, or they might be forced to participate in NVIDIA in the case of market makers or certain institutions that have certain mandates to keep up or have certain balances. For example, QQQ ETF will be required to maintain their market cap, their market weighting. So if NVIDIA starts to get bid up, then they need to participate. And so they will buy more NVIDIA as well. So other than that, we're not going to expect too much from institutions. So not much else to talk about. We'll see what happens after market and just see if what we said was true and NVIDIA absorbs all of the buying power today. Okay, so have a wonderful rest of your morning, and I will see you in the aftermarket.